In the year 1999, a company selling pet food online spent $2 million on a single 30-second television commercial during the Super Bowl. Their total revenue for that entire year was less than $600,000. Mathematically, they were losing a fortune on every single transaction. Yet, the stock market valued this company at hundreds of millions of dollars. How exactly does a business model that simply sets piles of cash on fire convince the most ruthless financial system on earth to blindly hand over its wealth? To understand this, we have to look at the greatest mass delusion in modern financial history. Before the internet, the normal state of the stock market was grounded in a very boring reality. A business makes a product. People buy that product. The business takes the revenue, subtracts the costs, and whatever is left is called profit. If the profit grows, the value of the company grows. It was simple math. But in the late 1990s, a new technology arrived and completely broke the brains of Wall Street investors: the World Wide Web. Suddenly, the old rules of math were thrown out the window. To understand the loophole that Wall Street exploited, imagine you open a lemonade stand. Normally, you sell a cup for $1, it costs you 50 cents to make, and you keep 50 cents as profit. But in the dot-com era, you decide to give the lemonade away for free. Even crazier, you actually pay people $1 just to bring their friends to your stand. Naturally, you are losing massive amounts of money every single hour. Your lemonade stand is bleeding cash. However, there is now a line of 10,000 people wrapped around the block waiting for your free drinks. You take a picture of this massive crowd, you walk into an investment bank and you say, "I have absolutely zero profit, but I have the data of 10,000 thirsty people." In a normal world, the banker would laugh you out of the room. But this was the dot-com era. The bankers looked at your crowd and saw future dominance. They believed that capturing attention today would magically turn into a global monopoly tomorrow. They called it buying eyeballs. They called it website traffic. And they handed you a check for $100 million. This was the fatal loophole. The financial world shifted from valuing actual money to valuing hypothetical future potential. And once the greed engine realized that you did not need a profitable business to get rich, the escalation became absolute madness. All a founder had to do was add a .com to the end of their company name, or an E prefix to the beginning, and their valuation would multiply overnight. Companies that had no revenue, no viable product, and sometimes not even a functioning business plan, were going public and raising billions. The stock prices would double, triple, or even increase tenfold on the very first day of trading. This created a vicious cycle of hysteria. Seeing 20-something-year-old founders become paper billionaires overnight, the general public lost their minds. Normal people quit their stable office jobs, cashed out their life savings, and sat at home day trading technology stocks. The mob mentality took over. Everyone believed that the internet was a magical money-printing machine and that traditional valuations no longer mattered. When legendary investors like Warren Buffett warned the public that this was a speculative bubble built on thin air, the media and the new wave of investors openly mocked him. They called him a dinosaur. They said he simply did not understand the new economy. The market was completely infected by the fear of missing out. As long as the stock prices kept going up, nobody cared that the companies underneath those stocks were fundamentally worthless. The mountain of debt and empty promises kept growing higher and higher, fueled by an endless supply of cheap venture capital. But eventually, the laws of gravity always win. In the year 2000, the Federal Reserve started raising interest rates. The era of free and easy money suddenly stopped. The mountain had reached its peak, and the descent was going to be brutal. Without a constant injection of fresh cash from investors, the dot-com companies were exposed. They realized that you cannot pay your office rent with website clicks. You cannot pay your employees with user data. The lemonade stand ran out of sugar and nobody was willing to lend you another dime. The truth was finally revealed to the public. Behind the flashy commercials and the massive valuations, these companies were entirely empty. They had zero sustainable revenue. Panic set in. The smartest money in the room started selling quietly, but soon it turned into a stampede. The sell-off was violent and absolute. Everyone rushed to the exit at the exact same time. The Nasdaq index, which was heavily concentrated with these technology stocks, collapsed. It lost 78% of its value in a brutal downward spiral. Over $5 trillion of market value evaporated into thin air. Thousands of dot-com companies went bankrupt overnight. The founders who were paper billionaires on Monday were completely broke by Friday. But the real tragedy was the retail investors. The ordinary people who had bet their life savings on the promise of the new internet economy lost absolutely everything. The history of the dot-com bubble teaches us a cold, mathematical truth. Money is not created by hype or website clicks. A business must eventually generate actual profit. If a financial model does not create real value, the market will eventually correct itself, and it will be merciless. We see the exact same patterns repeating today. Whenever you see a new technology, whether it is cryptocurrency or artificial intelligence, surrounded by extreme hype and companies burning billions of dollars without a clear path to profit, remember the lemonade stand. History might not repeat itself exactly, but it often rhymes. Thank you for watching. Do not forget to subscribe to the channel and leave a comment down below. Do you think we are in another tech bubble right now? Let me know your thoughts. And stay tuned for the next video where we will look at how Wall Street took the bad mortgages of unemployed people, packaged them into financial bombs, and almost destroyed the entire global economy in 2008.